Well, the webinar is now live. Welcome, everybody. I'm Alfred Ritter, Montgomery Securities. We are an investment bank in San Francisco, primarily catering to the fintech industry and with an emphasis on digital asset securities. My guest today is Phil Mochan. He is the CEO and founder of Nomos Digital. Phil's got, I did a little research, not a lot, but now he's a fellow at the Royal Society of Arts, Manufacturers and Commerce. Interestingly, I found it interesting, computer engineer, marketing, corporate finance background or skills, education, combination there, experience in telecoms, internet, financial technology. But those are just kind of some of the things I gleaned. But Phil, I'd love for you to go ahead and give yourself give an introduction to the audience here about yourself.
Thank you very much. I suppose my background was originally in telecoms many years ago, over 30 years ago. And that kind of educates me in my look at the financial services industry, where I'm now starting businesses. And the focus at the moment is in cross-border payments. And there's a huge parallel in the nature of cross-border payments and its current technology and business model as to where telecoms was back in the 1980s. And I'm using that to sort of illustrate a direction forward. And before this, I was previously working with Coiny, which was in the capital market space, in the digital assets, done in custody and settlement, focused on the institutional side. Anyway, I hope those elements of understanding both the digital side of the world and the payment side will lead to a success in this new venture.
Great. Well, so Nomos Digital, I mean, let's talk a little bit more about kind of what your mission there. But before we do that, so I notice, and I don't know if this is just coincidence, but there seems to be Greek derivatives in a lot of the things that you've been doing lately. So I'm assuming that, nomos from Greek law, or I guess study of, or custom, culture, astronomy, economy, right? As we use it as a ending. Is that where this comes from, or is it something else, and I'm just appropriating something that's not there?
No, it is. It's the ancient Greek for law, intended to be a kind of indication that this is the finality of contract, a model that when you conduct a payment, it is a legally conducted one. That's the concept of it.
Great. So you're the definitive law when it comes to payments, digital payments.
That is yet to be seen, but that is the ambition.
That's the objective. So mission at Nomos and kind of what the business is primarily there. You want to give a little bit insight on where you're going and then where you're at stage wise?
Yes, I mean, it's very nascent stage. We've been thinking about it for a couple of years, and the team is just coming together to build that. I've done a lot of work in settlement and payment systems. And the idea is that at the moment, the problem is that the cross-border payments cost, let us say, $30 each, whereas domestic payments cost, say, 15 or 5 cents each. And you have to ask the question, why? And in analyzing that, we set a target to bring down the cost of international payments cross-border to about $1 within 5 to 6 years. And then further take that down to the domestic level in the subsequent 5 to 10 years, so that there becomes a same cost of doing domestic as international, much has already happened in the telephony space starting some 30 years ago. And the way to address that is to understand that it's not about technology, it's about architecture and business model. We've already seen a number of players come into the market to try and address the technology aspects of it. But when we come down to it, SWIFT, the predominant messaging format, is only 5 cents in the overall cost structure of $30. So it's not a significant factor, the technology component. So it's about changing the underlying business model. And that means, in the first instance, moving away from dispersed pools of liquidity across correspondent banks that require capital to be tied up in managing risk, towards a pooled version of that where you have much more efficient forms of liquidity utilization. And that's the first step. And that might take us 3 or 4 years to get going. And then beyond that, we have to then deal with the data component, which leads to high compliance costs and lots of what I would call in-process failures. 60% of Messages, according to Swift, require some level of manual intervention. So you can't do that unless you get data right. And that requires you standardize the incoming methodology of capture of data, not simply produce a better form for the sender to fill in, as is the current basis. So we want to see a switch to intelligent financial messaging systems rather than from relatively dumb straight-through processing systems. Very much like the transition as telecoms went through in the 1990s when it developed a centralized intelligence system called 3G mobile, where we had one ubiquitous, effective global standard, and you can make a call from anywhere to anywhere. And that is how I see a vision in time for the financial services industry or payments industry also.
Interesting. So, I mean, is it just a function of garbage in, garbage out part of the issue? It's not the underlying technology or speed. It's really inputs that are being provided that are not standardized. Is that somewhat accurate?
Well, one way of looking at it is that the existing payment system is a huge exploration in distributed trust models. We have 30,000 banks that are connected onto the global payment system as gateway keepers. And their job is to make sure that only the right people get on board and to conduct the right KYC on them. Now, what happens is that because of the distributed trust model, there is descent to the lowest common denominator. There's always a bank that will reduce standards in order to make a short-term profit. And this leads the whole network to degrade to that lowest base level. We've seen Danske Bank with its hundreds of billions of Russian money. We've seen HSBC, laundering money across the Mexican border for drug cartels. This is all a consequence of the search for immediacy over the overall trust of the system. So distributed trust models in payments don't really work, which is an education, for example, in the digital asset space, where people are saying we really ought to go for distributed trust models there. I think that's fundamentally fraud. They've already been demonstrated to be inadequate. And all that happens is that regulators come along and put overlays on top of them, such as the SARS regime, which is, of course, ineffective. So I think it's about re-architecting the systems towards centralized trust models. And without that, I can't see that we can achieve a $1 cross-border payment.
Got it. And is there, okay, and any so in that business, you're also doing a foreign exchange transfer? I mean, are you just transferring dollars for dollars, or is there a Forex component as well inside of that?
It's designed for the Forex as well, and also to provide payment liquidity. One of the things we're looking to do is perform riskless, instant cross-border transformations, and in order to make when you make that riskless, you start to then have incremental liquidity problems, because you've got to be able to supply the FX at just the moment of the transfer, and you've got to be able to have the funds already pre-provided on the other side. You've got to have funds both sides, and banks don't want to tie up more capital than would otherwise be the case for netting regimes. So you have to have solutions to that. And part of our solution is really to use domestic banks to provide pooled Vostros-Nostros accounts where they can pitch capital to meet the requirements of other banks for short-term lending, early or intraday. And similarly for the FX to be dealt with on the other side by the domestic banks bidding for the right to supply the capital at that point of payment. So we create huge increases in the efficiency of capital allocation on both the sending and recipient end. And we reduce the capital that needs to be allocated for the risk side of the equation.
So lower reserves, essentially, than what under normal circumstances would be required in all of these separate corresponding banking relationships, right? To ensure for counterparty counterparty risk, right? To address counterparty risk.
Yeah, I mean, an example is correspondent banks tend to want to demonstrate that the liquidity profile is very robust. So they will have as much as 130% of their liquidity requirements in tier one capital. And the reason they do that is because a lot of their capital gets trapped in overseas into various regulatory regimes. And so if you can eliminate the requirement for that, that 30% excess can be removed from the system. And then that's quite an improvement in capital efficiency.
Then now, so you improve the capital efficiency, and it enables them to generate more revenue, essentially.
Exactly.
Which is a good thing for banks, because they're always looking for revenue opportunities.
Well, let's be honest. Some of the banks will not benefit out of it because they're able to attract kind of positions based upon their role as major correspondent banks. And the opacity of their fees arising out of that allows them to book significant profits to the detriment of the other banks, the thousands of other banks. So there are perhaps, there's 11,000 banks on the SWIFT system, but perhaps only 20 major correspondent banks. And it is the 11,000 banks that would benefit from this approach, not the 20.
So it's hierarchical in terms of distribution of who profits. Got it. So I want to mention one thing to folks who are in the audience today. Questions. We have a chat feature. We can ask questions there. There's also a Q&A feature, so you can ask questions in that area as well. So if you do have questions, and then I'll address the questions then towards the end of the presentation. Or not, I guess it's conversation more than presentation, and then we'll take those at the end, basically. Great. Well, let's switch a little bit here and talk more about just in general, switching a little bit away from currency and cross-border payments to digital assets custody and settlement, and talk a little bit about that. And I kind of see it as an intersection of technology, law, regulation, and finance, right? And maybe there's other pieces there. But I guess the big question I have today is, is it resolved how the custody industry can support digital assets at this point, right? I mean, are we at a point where they've figured it out, or they're still learning to go?
Well, I'd say where we are right now is we got people coming up with technology solutions in the digital asset space. And they've yet to be tested against what might be described as conventional institutional standards. We see increasingly indications that institutional capital comes into digital asset space. And certainly as we move towards a digital securities environment, there will be a lot of institutional capital flowing in. So what are the issues that will still need to be addressed? Well, it's a complete area around both custody itself. How do you keep the assets safe? What are the duties of custodians? And how do they apply specifically to digital assets relative normal custodial duties? And I think that really hasn't been addressed at the moment as to what's both the variation and why there should be a variation of specificity to digital assets, and secondarily, why should the existing standards for custodians be different for digital assets? Let's take that one by a time. One of the duties of custodians is to always control the assets on behalf of the beneficial owner, right? Why should that principle change in the digital asset space? One of the second things they need to do is they need to prove unique ownership of those assets on behalf of those clients. Why should that change in the digital asset space? Thirdly, they need to maintain a separation of duties model so that, for example, neither the trading venue nor the fund manager that may be managing the assets is able to steal those assets. Right? Why should that change? These are sound principles that have nothing to do with the underlying technology, be it digital or electronic or otherwise. And then there are some specific aspects around the nature of many digital assets, but not all, which is to say that they are bearer instruments. If you have the private key, you have the ownership of them. And if that's the case, then why should they not be treated in exactly the same way as the existing rules state for bearer instruments, which is that they may not be traded unless they become dematerialized and cease to be bearer instruments by having ownership rights attached to them. Okay, very sensible existing regulation. Why isn't it implemented? But then again, we might look specifically at the nature of, say, the bearer instrument and see, is there anything special about it that might need us to change those rules? And indeed, if we look at the bearer nature of crypto assets, we find they are different from existing bearer instruments in that they are more insecure. If I have a $10 bill and I take a photocopy of it, I don't think anyone's going to accept it as legal tender.
Yeah.
But if I take a private key and take a copy of it, there will be no trace that that copy has been made, and I will be able to use that and extract value. So they are fundamentally less safe than most conventional bearer instruments, which have other protections around them. And therefore, one of the considerations must be in safeguarding them, it is probably essential that a custodian can prove beyond any reasonable doubt that no humans have ever come into contact with those private keys. Because if they have, the risk of copying would be present. And that is a burden of proof that has not yet, to my knowledge, been met by current custodians. But I'm sure it's a direction they will want to go if they seek to meet the needs for institutional clients. And I hope it's regulators that will enforce it.
Yeah, I mean, cryptocurrencies are bearer assets, like, say, currency, right? I think that's fair, right? But if we move into securities, then dematerialization, as you mentioned, kind of is what is the standard today for the most part, with I think with all jurisdictions at this point, and that requires those to be recorded with a custodian. So you no longer have Jeremy Irons trying to steal the bearer bonds from Nakatomi Tower. So that's no longer an issue. So that's good. But if we're talking about digital securities, these represent an ownership stake or an instrument, right? Ownership in an instrument or a company, well, those are controlled by somebody, right? An issuer. So I guess is that really a bearer instrument at that point? I mean, I guess it's issued to an individual, right? You got KYC, AML, all of those things, assumingly done on issuance. So you know who the owner is, and it's on a ledger. So are those really bearer instruments?
Well, it depends on the nature of them. If there's a registered ownership with them, and if in the event they get stolen, they can be reversed as a transaction, then they're clearly not bearer instruments.
Right.
So the test for bearer instrument is self-evident. If I've got it, and do I own it? And if not, if it can be removed from me, then it's not a bearer instrument. So
like that $10 note you have in your, or 10 pound, I don't know if you have 10 pound notes actually, in your wallet. If I came over there and took it out, then I would be the owner of it. So, okay, got it.
Possession is ownership.
Possession is ownership. So in regards to digital asset security, so if we want to switch and kind of more focus on, you have the traditional custody relationship that you have with other securities, and I mean, there's a requirement that those securities be held by a custodian. So how do you meet that criteria if you're an institutional investor and you want to invest in digital asset securities?
But in looking at that, I think we need to look at the entire kind of trade workflow model. And it's by no means certain what the endpoint will be of that. But my belief is it is most likely to be somewhat similar to the existing models. People are comfortable in dealing with what they're familiar with. Mm-hmm. But with improved efficiencies and specific remedies for particular specific risks that relate to digital assets. But if we look at that post-trade, and we're assuming they're not necessarily bearer instruments at this stage, then what you want to do is you want to really combine the settlement function with the custodial function, as that would lead to the highest levels of efficiencies. So in the existing model, we've got prime brokers, we've got transfer agents, we've got custodians, and then we've got depositories. And we have a T plus X model. For equities, it's what, T plus 2 in the US, and there's now talk of it bringing down to T plus 1. And what that does is it provides credit risk and counterparty risk in the intermediate stages between the settlement and the clearing. And if you can move that to a real-time model, then you can compress the whole trade life cycle into a fraction of a second. And that would certainly reduce risk, which is the requirement to post margin if you have that risk. Now, people would complain about that would reduce the benefits of netting. And so there are pluses and minuses to the whole approach. But given the fact that a typical investment bank has 70% of its cost base tied up in the post-trade processes, I think there's a strong indication of the efficiency that could be gained from integrating the settlement and the post-trade solution into a single moment.
So, as similar to what we were discussing in the corresponding banking and the current banking relationships, that they need to keep a lot of regulatory or reserve capital on their balance sheet to address counterparty risk.
Yes.
Yeah.
You can start to eliminate. Capital has to be used in different ways, and the use of credit is very important in the existing trading systems. So I would say there's still a lot of work to be done in understanding how credit mechanisms can support trading activity when you move to real-time settlement models.
Yeah, so real time, that's an interesting point. And obviously we're a net settlement world, right? That's kind of the world we live in. Even I've looked at ATSs in different situations, and we're still net settlement, and the transfer agents wouldn't know what to do with real-time settlement. I don't think at this point, right? It seems very that was. I've had conversations with them, and in the world of real-time settlement, seems that we're far away from that.
Well, a lot of people have built business models out of the time it takes to settle, right? Sure. And if you remove that time, you harm their business models, so they will most likely be opposed to it. But it would seem to me there's a huge benefit to the overall system in moving that way, and it also seems inevitable. So it's about how do you manage that transition in a way that causes pain in the right way. So
if we integrate custody and settlement, what's the effect on that to the current incumbents, right? I mean, it's going to obviate the need for some people, or how does it affect the current incumbents, and who's disrupted by that? I guess is my real question.
Well, I think for the investment banks, it's a very positive move. For the prime brokers, it can be a very positive move. They will allow them to cap costs. It will increase the efficiency. And they might even gain market share as a consequence of that, because the smaller players will find it difficult to keep up. So I think the big guys are going to do well out of the shift to the systems, particularly those that lead the pack. I think they see the advantages of it. The other people that will probably do well out of it are the existing core infrastructure providers. Now, I can't judge exactly which ones will win. But for example, in the European regime, Clearstream and Euroclear would seem to be winners out of it because they perform a lot of the functionality, and they're the natural transitional parties to run it. In the US, it's a little less clear because you have more parties involved in these systems, more fractured approach, if I could call it. And therefore, I think there's a lot more room for a new entrants to take over a lot of the post-trade market infrastructure. The brokers, I don't think they'll be affected by it. I think they will do their business, because it's not their business that's being modified. It will simply become more efficient for them. They will have more tools for managing their positions. They'll have more tools for auditing and delivering value to clients. Real-time NAV is a possibility out of it. Real-time audit, being able to track whether fund managers are operating within their fund parameters, again in real time, is all likely to emerge in the coming years.
And what about the impact for regulators, right? Where are they at in this change, right? And how do they benefit or affected by it? And there is resistance from them, obviously, to adopt something radically new, right? So again, to your point, the incumbents in the institutions want to do business the same way they've always done it. I would assume the same is for regulators. They don't want to necessarily complete change, right? But how are the regulators? What's the impact on regulatory agencies?
You've got these two groups, one called innovators and another called regulators. And they're in a tension between them. And the innovators are going, why don't we change the rules so we can do things differently and disrupt the incumbents? And the regulators rightly go, but why? Why should we do that? And I think for the most part, the regulators are correct, right? They may be a little stodgy, but their principle is to protect people from bad actors. So I believe that where they operate a principles-based model, which is not to say, for example, blockchain is a technology we need to regulate, but instead saying how information is held about financial assets needs to be regulated. I think the pathway for regulators going forward is to not be caught up in the jargon of the moment or the immediate rush of innovators to say, do it differently, but to stick with the fundamental principles that have been built up over the decades and move forward within that, giving space for the innovators to operate. I think that's a difficult thing to do. Most regulators have not been successful at it. And most of the examples come really in the smaller countries, places like Gibraltar, Switzerland. They've been far more innovative in trying to understand what needs to be, how the regulation needs to move. Not just changing the existing stuff, but setting an operating framework for the future that will positively encourage development. Now, one of the things that will arise out of all this is that capital is going to be increasingly able to move easily. We see all this already with the likes of stablecoins from one regulatory venue to another. And therefore, there's going to be increased competitiveness, regulator to regulator, to get it right, because there won't be an ability to hold back the movement of capital. And therefore, to think that you can simply sit in your conservative seat and say, for example, we are the US regulator, therefore we are the power, is a little naive in my view.
Well, certainly there's, when you have, I guess I kind of look at it, you look at the dynamic between Singapore and Hong Kong, right? For example, right? They share a similar, regional position, right? And they're smaller places. One may be more Chinese and one dominated in terms of where the capital's coming from, and one more Southeast Asia. But for the most part, they're kind of competing. Their capital markets are competing with each other and their institutions and to get deposits and to get money to move in there. So they have more, and I think they've been. And there's other places too. I think Dubai, you look at some things that are happening in Dubai recently or more recently in regards to the digital space, right? They seem more innovative, right? They seem to more friendly towards innovation. They have sandboxes and they're allowing for experimentation and iStocks in Singapore, and Fusang so there's in the region, right? So there seems to be more movement there than in the U.S., right? Although the U.S., but the SEC is, regulates the largest capital markets in the world. So there's more downside, I guess, for them to get it wrong. So they're going to be more conservative. I think that's just kind of typical in how innovation works. So I see that as being very much the case. But so there are jurisdictions. I guess my question is, there are jurisdictions that are more amenable. In your experience, I mean, have you found that too? And what's your kind of outlook on the areas that you think are, getting it more right, I guess, than others, or there's more opportunity in for capital markets?
Well, the US is deservedly conservative. As you say, it's the biggest capital market. And I'm not suggesting it shouldn't be conservative. But it has to embrace the digital changes in a proactive way rather than a reactive way. It's not so much what you do, it's your attitude that really determines it. It's, yes, let's make a success out of the digitalization of the capital markets, rather than how do we hold back and prevent increased risk. You've got these two different attitudinal models. And one of the things that these younger, smaller countries are doing is recognizing that this digitalization of finance will lead to more global flows. In other words, geographical boundaries will start to vanish a bit over the time. And therefore, as I said, the US regulators will have less control because US capital will simply flow out. And the second thing that's really happening here is at the moment, the way that capital is allocated into these markets is primarily through large institutions. I mean, you have a very big retail market in the UK, in the US as well. But outside of the US, there's not very large retail markets for investment. Most of it is institutional. But what we see is massive growth in retail finance in Asia. And vast quantities of newly wealthy younger people are wanting to deploy capital into the securities markets who haven't had that opportunity. I mean, you only have to look at the Alibaba wealth management platform to get an indication of the future of Asian capital markets. The whole flow of capital will be inverted rather than individuals passing it into large institutions which then invest on their behalf. It will flow directly into those markets, and you could see that the trading venues, the likes of Binance, could become a major player, not just in the crypto space, but in the securities space, because they've got the customers, the retail customers. I mean, you have to recognize they're making more profit than any other exchange in the world, including the conventional one. So the profitability of the underlying exchanges will be a factor in determining the ability for them to invest and develop. And the US the US regulators have to recognize that.
That would happen outside the US if they don't allow it, right? Basically.
They don't respond it, yeah.
Yeah. Well, and
US capital will flow to Binance.
I mean, so you mentioned earlier in the conversation about separations of duties, essentially, right? And I see some of these Binances and Coinbase, and that they're the exchange, they're the custodian, right? They're I don't know I forgot the third one. they're basically they're the broker, right? So they're like all three rolled up into one. Like that's kind of a problem, right? I mean, or potentially could be a problem, no?
Well, retail clients don't care for the most part because they're not wise enough to remember the last time that all went wrong, which is why you have regulators to protect the retail clients from the abuses of the system. And in my view, the regulators should be stepping in more vigorously to, for example, ban any crypto venue from also offering custody under the same ownership structures, right? They say, oh, but it's a different person
crypto venue meaning
operates it.
Crypto venue meaning exchange.
Exchange, yeah. Well, it could be an OTC desk, it could be whatever, all right?
Right, but
you basically want to separate it out.
Separate those apart. Yeah, I think that's true. Yeah.
And the next function that should be separated out is settlement. I mean, at the moment, if you settle on, I don't wish to be disparaging to Coinbase, they're all the same, but you have this irony that you're running this stuff called digital assets, and yet it's settled not on a digital platform, but on an electronic book, right? It's settled on an electronic book, which is unregulated, which has got no standards, it's got no regulatory oversight, it's got no governance. how do you know what's going on? And we already know that on certain venues, that settlement processes conform to standards which have long been banned in conventional markets. So again,
like painting the tape, different things like that, where they'll trade ahead of the other people, or giving preferential, moving somebody ahead in the queue. So
exactly. The matching engines will give preferences to certain client bases. Right?
Yeah. Well, certainly if we move into the securities world, then they're going to be regulated by securities regulation, which would not allow that to happen. Or as long as the regulators are up on their game. Okay, so I kind of wanted to talk a little bit about settlement, because settlement involves obviously the exchange of the asset, right, and the exchange of the payment for that asset. So it's interfacing with the banking system, and how does that affect your T plus X, right? Your settlement, right? I mean, I guess that, because if you're still dealing, if you have a digital asset that could be traded basically could be sent instantaneously, but if you're still relying on a bank transfer, or that takes time, then I mean, how does that affect this world of digital asset securities, and what are the solutions there to speed that up?
Well, I mean, at the moment, everything is happening primarily through venues or exchanges or OTC desks.
So they have their cash in the wallet.
And most of the settlement models are FOP, free of payment models. So you give me the asset, and then I promise to give you it back later. The other half, and that can be that T plus X. The X can be an hour, or it can be next day. It's not T+2. It's much quicker with these systems, but you've still got a time frame, and you've got a counterparty risk and a credit risk. And unlike, say, conventional institutional trading, you haven't got any real assessment of that counterparty risk. I mean, what is the risk of an exchange going down? Difficult to determine. Is there anybody who's independently rated it? No. So not only have you got the risk, it's very difficult for traders to evaluate that risk. Okay. And we've seen in the past, because we don't know the rules by which they govern themselves. Right. Too many of the venues at the moment simply operate under their own rules. They have a regulatory framework which is primarily focused around KYC and AML, but not around the governance of their activities, which is running an exchange or running a settlement house or running a custodian. So there's lots of vulnerabilities there. Settlement itself, you've got an option of using a digital assets model, which is called atomic swap. But atomic swap doesn't have legal finality because legal finality is something that's set by law, right? You can't just say, I've got finality. You have to have a legal construct around it. And at the moment, that hasn't been addressed. And besides, atomic swap is primarily a contingent liability. And therefore, again, it's not ideal. Whereas what you would really prefer to do is probably run a DVP model, a delivery versus payment model, where the settlement was effectively riskless. And if you could run that in real time, then that further reduces risk factors. It would also improve trade efficiency and capital efficiency, and would allow much of the HFTs, the high frequency traders, to significantly grow their volumes. And that could be a major factor in managing price volatility in the crypto assets.
So delivery versus payment is simply just when payment is received, then we deliver whatever you bought.
It's a simultaneous event. There is no, and it's legally binding.
So it happens upon when those two line up and occur, and then they can cross the trade. Yeah. I want to see. I have a quote that were quoted in, I don't know where it was, Cointelegraph maybe, It said there will be a shift from crypto evangelism to capital market pragmatism, and the anticipated mass adoption of blockchains will become more grounded in operational reality. Capital markets infrastructure will lead that realignment. So a couple of things on that. Crypto evangelist, capital market pragmatism, right? I mean, the whole, the broader DeFi, movement, I guess, let's call it that. I would say probably not as popular, right? I mean, this viewpoint, right? And not that it's a bad thing. I think I actually agree with it, right? I mean, I think that, that if you want orderly functioning capital markets, you need rules and you need, operational things. So but I also wanted to ask about do capital markets infrastructure lead the realignment, or do they react to the realignment? How that's a big question. Like, how do you see that? Like, do you see or is it just a matter of the ones that do are more proactive, right? And then like we were saying earlier, are the ones who will benefit from it. What are your thoughts? I want to just dig into that a little bit more.
Well, I mean, my view of what's likely to happen is based upon what I saw in the telecoms markets. And a lot of people back in 1990 could not foresee that the champions of those industries at that time would not obviously succeed. And yet, here we are, 30 years later.
Like BT.
Yeah, the incumbents would always, yeah. And
whoever.
It's quite obvious that we now have major companies that never existed then.
Mm-hmm.
An example in the telecom space might be Vodafone, for example, which started in the 80s and has become one of the biggest players in the world. And the incumbent, say BT, is modestly much smaller than it. So the question mark is, what are the predeterminants for success of incumbents? I think there's no automatic situation that says they must die. And I think it comes down to not their market position or their products. It comes down to their culture and their leadership. And that's what we've really seen. It's the businesses that lead their institutions forward that will succeed or have most chance of success. And it's those that wait around for something to happen that fall off. So it's culture. I can't name it anything simpler than that. It's about the underlying culture of the institutions that are there.
Yeah. No, I agree. I mean, it's the innovator's dilemma to some degree, right? And the incumbents are, optimizing it for their largest customers, their current customers. They're not looking at, customers who aren't even customers yet, right? Because they're not going to develop something for that. So it's hard for them to innovate. So I mean, that plays out in all sorts of industries. So it's not unique to either telecoms but technology in general. Very, very much challenging.
But you tend to find it goes in waves, though. You tend to find that the incumbents think, oh my God, we're a bit fearful of these new guys. And then a few years passed and they went, well, nothing happened. And they start to relax a bit. And then what happens is the wave of innovation really does hit them and starts to impact them. And then they go through a next phase where they go, well, we better buy up all these upstarts. I think of AOL, Time Warner, and say, and that way we can sort them out. And they think that will defer their decline or improve their market position. And they tend to be deluded about that again. And then what they find is the new guys are buying them out because their market values have declined, not their revenues, just their market values, because the market no longer has faith in the incumbents. And that transition can happen extremely quickly.
Well, we'll see. I mean, Coinbase is set to go public here in the U.S. Their last raise, I mean, they haven't raised money for a while. So that's, that I think they raised at an 8 billion valuation. What I've heard recently is that the valuation will be in the $100 billion range. Don't quote me on that, but that's what I've been reading. And I read the same things you do. It's public information. It's not something that has any privacy on it. So we'll see what then they do once they're public. And I mean, they've made acquisitions in the space already, and I would assume they will continue to make acquisitions. And what they acquire will be interesting. It'll be interesting to see how that builds. I mean, I think in the digital asset world, I think Coinbase is probably the largest entity out there. I mean, certainly by market cap.
At the moment, but I would suggest that Binance, if it ever goes public, which it may not be able to, but if it ever does, would easily surpass it.
Sure, I don't disagree. I don't disagree with that. Plus, so there was one question in the chat, and I'm not quite exactly sure, but it was what are transaction taxes levied by what are the impacts of transaction taxes levied by governments? So I don't know if this is in regards to the Forex discussion and the $30 we were talking about. Maybe that was that, but maybe you want to respond to that in a general way, but maybe think about it in relationship to the $30. Like, what was the impact of taxes?
Well, my belief is in the future of payment systems, and this will be settlement systems as well, is that taxes will be collected in flow. Mm-hmm. So, for example, if it's a retail payment and you pay for something, the sales tax will be dynamically collected by the revenue authority as you pay for it. And that is undoubtedly the future. And similarly, when you are in flow for settlement activities, all fees will be deducted, or taxes will be deducted at that point of settlement.
So, which is better? I mean, that means governments are realizing taxes in real time.
Real-time tax collection, yes.
That should be a benefit for governments. They should like that.
Yeah. Well, and it will be fully all of the the relevant documentation to support that transaction will also be available. That's the other aspect of it.
You mean the audit, kind of the audit?
The whole audit trail. You know,
Audit
they
trail.
know exactly why they've charged that tax, and so it's indisputable.
Yep. No, I mean, I get it. I mean, we've experimented with a lot of different things. So, I don't have much more. That's kind of the time for today. But I'd be happy for if you want to, if there's any prognostication, any forward-looking element, or if you want to talk about any of the other, I don't know if there's other activities or causes or different things that you're involved in that you might want to bring a spotlight on. I'm happy to have you talk about that quickly, and then we'll wrap it up.
Okay, I mean, thank you. I mean, I would say that the other area of interest, of course, is central bank digital currencies and stable coins, which everyone's talking about. And my own view is that the majority of central banks have some considerable way of issuing digital currencies. And I think it's also a bit of a misdirection, because people think it's about the technology of being able to do so. And fundamentally, it's not really about that. You don't have to use a blockchain to issue a digital currency. You can use lots of different underlying digital technologies to issue it. So it's nothing to do with blockchain, right? It's something instead about how fundamentally you want to change the allocation of credit. That is fundamentally what digital currency, central bank digital currency is about. Do you want to allocate credit via the commercial banking system or through the central bank? Mm-hmm. That is the choice to be made, and it's a policy decision. One of the big concerns about central bank digital currencies is that they can lead to bank runs, right? Because the central bank does not do maturity transformations, and the commercial banks do. If people feel that things are going wrong, they'll dump the money into the central bank, and all the banks will go bust. Mm-hmm. Right? So that will create systemic instability, and that is a big concern for central banks.
Well, one thing I want to just get your take on this. Obviously we see companies like Tesla, Stripe, PayPal, other companies that are adding, taking cryptocurrencies and adding them to their balance sheet, right? I mean, do you foresee a central bank adding cryptocurrency to their balance sheet?
I don't, but But I see this as part of a trend to what I would call diversification of reserve wealth, right?
That's true. Yeah.
Which will happen both in corporates and in high net worths. Typically, high net worths held their money in dollar deposits or treasuries. And that was the primary, and a little bit in gold. And I think what digitalization will allow them to do is diversify that reserve wealth. Very low yielding, but very safe. So we'll see them put them into digitalized diamonds, digitalized commodities, digitalized technology metals, digitalized treasuries. And so they will be able to have, let's call it, a safer portfolio, a broader portfolio of reserve assets.
Yeah. I mean, I definitely see. I mean, that's happening. I know personally. I've done it myself. So, when I look at how many dollars are being printed with stimulus packages, and then we're talking another almost $2 trillion coming up here in the U.S. I think about what the effect of that is on the U.S. dollar, and I don't think it's to the upside. I think it benefits real assets, and I'm not a big gold holder because I don't. You got to pay to store it, and I'm cheap, so I don't want to do that. And so I look at I looked at digital assets and spread some money into some different, Bitcoin and other cryptocurrencies. And so far it's been good, but it could be, you don't know what's going to happen tomorrow, but I feel more comfortable. I feel like the indications are if it's in dollars, it's going to be worth less. You're going to be, you're going to need more to buy the loaf of bread tomorrow.
Yep.
Maybe not that quick, but there is more talk about inflation. So we'll see how that works out. So anyhow, Phil, listen, I appreciate it. It was kind of a more intellectual, stimulating conversation. And so I do really appreciate your contribution here, and, appreciate it. If anybody like to get a hold of you, is there, you have a Twitter handle or anything that you want to share with people, or I wouldn't give out your email address or your phone number, but maybe there's a website they can go to and look you up.
Well, at the moment, no, I haven't got one. And so you can give up my email address. I'm quite happy with that.
Well, go to LinkedIn. I mean, they can look you up on LinkedIn and connect with you there. That's the best thing. So find Phil on LinkedIn and we'll listen. I'll make this available. We'll record. We'll put a recording up, so it'll be memorialized and somewhat edited. So it will. If there's any gaffes, we'll make sure to take those out. Anyhow, okay. I really appreciate it. Thanks for your time today, Phil.
Thank you very much, Alfred. And thank you for the audience for listening. Appreciate it.
Absolutely. Thanks everybody who could attend, and until next month, we'll talk again. Bye now.